So in this video, we're going to go over some terms that you're probably going to hear a lot, and you're probably going, what is that? I remember when I first started getting into trading, I would hear a lot of these terms and I was super confused, and I really just wanted to have that general understanding of what everything meant so I could put it together myself and create my own understanding. So that's what we're going to do, and I'm just going to go through some of these and explain what they are and their meaning, and then just give like a quick example of each. So BSL, if you ever see BSL, this stands for buy. Let me just put this, okay? Buy side liquidity, okay? So that's what BSL is. Mind you, I'm just going to run through these real quick and add their actual full name. So this is sell side liquidity. Okay. So those are very correlated. So we just went over in the last video fair value gaps. So that's why this is FVG. This is our fair value gaps. Okay. Now our IFVGs are very similar, but they're just inverse fair value gaps. Fair value gaps. Okay. And then SMT just stands for smart money technique, or some people like to call it a smart money tool. So you could call it that as well. Okay. OB just stands for order block. So sometimes you will hear bearish or bullish order block, but order block all the same. If you see BOS, this stands for a break of structure. Okay. Boom. Displacement, that is just a topic we'll get into in a little bit. There is no acronym for that. If you see CISD, this stands for a change in the, let me highlight that to be capital, in the state of delivery. Okay. Change in the state of delivery, meaning if we are bullish, this signal marked out on a chart would signal a change from, let's say, bearish to bullish or bullish to bearish. And I will give you an example of that, but I'm just going to go through and give examples of these when that time comes very soon. So we got that. Okay. LRL, sometimes you'll also see maybe an extra R at the end of this. Either way, all it stands for is low resistance liquidity. Okay. And then EQ just means equilibrium. Okay. All right, now that we have these broken down into their actual full names, I will go through and give an example of each. So buy side liquidity, we'll just start off first. So I'll bring it down here. Okay, so buy side liquidity is basically when you leave behind, as we talked about previously, liquidity above highs, right? We know this. Buy side liquidity is just liquidity on the buy side, okay? So it's just liquidity on the buy side, okay? Meaning there was liquidity left when we were on the side of buying, okay? People are buying here, right? So if we had an order to buy, right, it would look like this. So as people are placing their orders here, doing this basically, this is liquidity from the buy side, right? And how I think of it as, I just think of when people were buying, we were just leaving liquidity on that side, if that makes sense, okay? So same thing with sell side liquidity, right? If we have like lows here, right? And let's say we're doing this, okay? This would be our sell side liquidity, because we did it when we were selling, okay? So I hope that makes sense. That's pretty simple. That's how I like to think of those definitions. But we will move on to the next term, okay? An SMT, right, is when an SMT is when two correlated assets move in harmony, and then one of the two leads the movement. Okay, so for example, let's say we had a key level here, right? And let's say we also had that same level here. Okay, so I'm going to split the screen, and let's say that we were doing something like this, okay? And we were trending lower, okay? And we ended up taking this liquidity pool out, right? Okay, and I'll just mark this out with a $sign, okay? So we tap into that level, and then let's say we decided to start going higher and taking out all of this liquidity, okay? So let's say this was NASDAQ, so NQ, right? And let's say this is the S&P 500, notated by the acronym ES. Is it acronym? Like, bro, I might be slow. You know what I mean, though. An SMT is when we have divergence in these assets, right? So that is when the behavior of one dictates kind of the other. So in this case, an SMT would be when one level gets tapped into, but the other one did not have to go into it. This is SMT. So this is a sign of reversal. So SMTs are signals of reversals or reversing, okay? So if we take out one level on NQ and then ES starts following the behavior of NQ and it didn't take out a level, then we can be pretty sure that we don't need to take this level, okay? So that's pretty much what SMTs are. It is a signal of reversing, and it is a smart money technique for catching reversals, okay? So I don't really use SMTs for catching reversals, I guess. Yeah, so that's what SMTs are, okay? So we will move on to a little bit more simpler things. So we have swing high and swing low, right? All that a swing high and a swing low is quite literally exactly what it sounds like. It's when you have at some point a very high level of price swing, okay? So this would be your swing high and this would be your swing low. And then everything within it is just kind of noise and whatever, and that's kind of that. So that would be your swing high, that would be your swing low. Very simple, no need to overcomplicate that. It's exactly what it sounds like. Okay. Moving on, we have displacement, okay? So let's say that we were trending higher, right? Just like so. And in order for us to have displacement lower, I want to see something like this, right? And maybe we start trending, but all that displacement means is that we are displacing level of prices. So here we had a swing high, okay? Swing low. What did we do here? We moved up and we displaced higher. So the way I like to think about it is when we displace, we are now setting a new standard or new base level of where price will go. So at this level here, okay, so when we were at this point right here, we went up and then we went down. So if I were to mark out and we're going to get into equilibrium, and I guess this could just be an example of equilibrium. But as you can see, when we went up, we then went down into equilibrium and we rebalanced, so then we could go higher, okay? So when we go higher, we displace higher, and then when we go down to equilibrium, equilibrium here was this level, and now equilibrium is now here. So it's displaced a little bit higher than it was before, or it didn't have to go as low, if that makes sense. So when you displace in one direction or the other, it's just a strong push in one direction. Okay, that's all that displacement means. I don't really think a lot of people explain this enough, but imagine if you threw a softball or a baseball really hard, right? You're displacing its current placement. So yeah, that's how I like to think about it. Okay, so we learned displacement. Okay, equilibrium. All that equilibrium is just the middle of something. So in this case, there's equilibrium of my fair value gap box. This is just a tool I like to use. You can actually use the Gann box, okay? And equilibrium is, like I said, half of whatever you're marking out. So if I just drew out a quick example of, you know, a range, or, you know, just price, whatever, okay? Let's say that's like a couple hours of time. If I wanted to mark out equilibrium, I mark out I need actually to draw this out a little bit more. Okay, let's say we had something like that. So I want to mark out the lowest point to the highest point. So swing high to swing low. And equilibrium is in this right here, okay? Nothing very complicated about that. Equilibrium is exactly as it sounds, okay? Low resistance liquidity is, like I said previously in one of the last videos, liquidity rests below highs and lows, okay? So that is marked out perfectly as it should, okay? So one rule that I go by is I never like to trade against low resistance liquidity. So if I see this, I would like to trend or be a part of the move up, taking this out. So the reason why this is low resistance is because it is so close next to each other, right? So price will want to take this out, okay? Just because if I take out this one, well, then it's pretty easy to get this one, and then it's easy to get this one, and so on and so forth. That does not mean you're going to take out all of them, but you could have stronger conviction when seeing this. Now, I don't think I've ever really heard about it before, but high resistance liquidity would be something like this, where let's say the highs are just a lot farther away. Are these still going to get hit? Yes, probably, but this is much more probable. So this is what you'd probably want to stick to trading toward. Okay, let's go over break of structure. So a break of structure is when we cross through and break through the current level that we had. So on a trend upwards, on a bullish trend, we create a high, a low, a higher high, a higher low, higher high, higher low, okay? Every time that we break through this level here, the high, that is your break of structure. Okay, boom, right there. Then we do it again right here. Okay. Now, I'm also going to mention CISD, or some people also like to call it a change of character. So anyways, a change in the state of delivery and change of character is the same thing. So don't be confused or think that someone is gatekeeping something that you don't know about. It's the same thing. Okay, so a break of structure is when you are breaking through the trend levels, I guess, or like the stairs, if that's how you want to think about it. Okay, so a change and the state of delivery is, it can be similar in your brain when you're thinking about it. I used to get them confused, right? Let's say we now did this, okay? This level right here is your change in the state of delivery, and I'm going to explain why. So I used to think, oh, well, if my structure is bullish and I have a break of structure, then I would call this a break of structure. Okay, this is something I actually used to do, guys, when I very first started learning these concepts and I was a newbie. I would think that in my brain, logically, break of structure to me makes more sense to be this, right? This is the structure and then we broke it, okay? Obviously, I was wrong. That's not what it means. When someone says break of structure, you have to think about it like this, right? So we had some structure here and then we broke it, okay? And then we had some structure here and we broke it, okay? Change in the state of delivery means that when we were making these highs, lows, higher high, higher low, higher high, higher low, right? Did we ever come down and break this level? No, we did not, right? We never came back and swept any of these lows, okay? But at this point right here, price starts heading down and we finally cross below a low, okay? And then on top of that, we rebalance, and let's say there's a gap here. So we have a bearish gap along this way down, and then we respect it, meaning we don't cross above it. We go into it, we fill that region of price, and then we continue lower, right? So this would be your change in the state of delivery level right here. Because, like I said, when we were trending up, we never made a lower high and we never made a lower low. We're making higher highs and higher lows in comparison to the previous. But as soon as we break below the low here, that's my first signal that we might be changing our state of delivery from bullish to bearish. Okay? And then we respected the gap. Now, let's say there was a gap here. I know my drawings are probably getting confusing, I'm sorry, but if you can keep up, this will make a lot of sense. So on this leg here, this is our bullish trend. So we have a bullish gap. We break below our level. We also disrespect a bullish gap. And then we respect our new bearish gap. Those are all signals that we are fully changed in the state of delivery from bullish to bearish. Okay, so I hope that made sense and you were able to absorb that. Okay, I know it can be confusing when you're brand new. I promise if you keep on absorbing these ideas, it will not be that difficult. Okay, so next thing we'll go over is order blocks. I don't trade these, so I'll go over these very quickly. Basically, all an order block is a block of sell and buy orders contradicting each other, leaving a confused pool of orders. Okay. So this is how I like to think of order blocks. Okay, so when I draw it out for you, we will have, and I'm not going to draw it out with candles, I'm just going to draw it out with lines. But imagine people here, right? So people were selling here, buying here, selling here, buying here, selling, buying, right? And then let's say we just start doing something like this. Okay. Boom. That's just an example, random example, okay? So an order block gets marked out by basically just the range that accumulated all these random orders, okay? And the way people use them is if I were to extend my tool, right? So only, let's say, you know, realistically, those order blocks happened in this area, but when I mark it out with my tool, it's going to extend all the way over so that I can see to the far right, where my area of interest is. And when we tap back into it, we can head lower or vice versa, another way around. So yeah, I will show you a quick example of what this looks like on the chart and how you would mark it out. If you find that order blocks make sense to you and you want to trade them, be my guest. I personally don't really find them that useful, but it's all subjective, and whatever you find makes sense for you, go for it. Okay, so I'm gonna look at the 5-minute here. Okay, let's see. Do we have any good order blocks? Any good 15 minutes? Okay, so basically, I would consider this an order block, right? Now, it's not a very good one. It's not really in a good place where it tells a big story or anything like that. But the way I mark it out is, or how I view it is, this candle right here, we opened here, we went lower, okay? We went up a little bit, we opened this bullish candle, we went up, we opened up this bearish candle, right? We went down, we opened up this bearish, right? So this is why I mark it out in this way, or why I call it an order block or block of orders, is people are really fighting each other. Bullish and bearish buyers and sellers are not being able to decide what direction they want to head in. Okay, so over here, people were willing to sell and everyone agreed on that. Okay, so we started selling off, sold, 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 slowed down, picked up pace, sold, slowed down, retraced, right? And then we headed lower. And this would be an example of a pretty clean 15-minute gap. So mark it out from the bottom of the first and then the top of the third wick. And price slows down as we had already made it. And then when we go back into the range, we start to slow down and then we head lower. Okay, so that is an example of fair value gap and an order block. And like I said, I don't really like order blocks, so I might not even be the guy to really explain them to you, but that's my general understanding, and I just personally don't find them very useful. Okay, now I have not gone over inverse fair value gaps. Okay, so I will do that real quick. So as we know, fair value gaps are looking like this. So we have our second candle, and then we will have our third candle, right? So there we go. There's our third candle, and then we mark it out just like this. So let me change my color, right? So we have it just like that, all right? Then we have our dashed line, right? Okay. Now, an inverse fair value gap is, when, in this case, if this were drawn out with a line, right, we have the gap right here. Now, a fair value gap is just when price bounces out, like so. Okay, this is a normal fair value gap. So I'll mark it out by FVG. Okay. Now, an inverse fair value gap is when we have the gap, okay, like this, and instead of respecting the gap, we just go through it, okay? So we just inversed the gap. Now you're probably thinking, well, when would I want to use a fair value gap and when would I want to use an inverse fair value gap? That right there is a very good question, and that lets me know that you are free thinking, right? So when you're trading, Guys, do not take signals from anyone else and get in a Discord and do all that stuff. You need to be a free thinker and build your own discretion and be able to tell a story in your own mind and have conviction in your own trades. If this is something you want to do long term and make actual money from, how are you going to do that if you don't actually understand it with your brain? Okay? So, like I said, how do I know how to trade a fair value gap and how do I know when to use an inverse? Okay, so let's say, for example, I had a bias of being, I don't know, let's say bullish. Okay, in this case, let's say we were trending bullish. Okay, and now we're trending lower, right? And let's say that we respected our FVG along the way. Okay, so this right here, another terminology thing you should know is leg and manipulation leg. Okay, so when someone says the leg or the manipulation leg, all that means is, let's say we had a swing high, right? And then we were going lower, right? And we did something like this. So let's say we had a gap here, right? So we went down into our gap and then we were heading higher, right? So if your bias was bullish, right? But this leg, and leg meaning the portion of price or the series of candles, and I'll just mark them out with lines, that was heading downwards, right? But you're looking to take a position to go higher, your manipulation leg is the series of candles created that are going in the opposite direction that you are trying to favor. So in this case, the manipulation leg is just the leg that's in the opposite direction, okay? So when you use an inverse fair value gap, you use it as a signal or an indicator that you're heading in a certain direction or not, okay? So with this example here, we have a leg of price, right? So before here, this is a leg, right? This is a leg. This is a leg, this is a leg, and this is a leg. Because it's its own individual short-term change of price, right? So on this leg, we were bullish. On this leg, we were bearish. On this leg, we're bullish because we're going up, and then we're bearish, and then we're bullish, okay? That is kind of the confusing part of trading, I guess you could say, is that this whole trend here is a bullish trend, but you have micro changes in price, right? We had to be bearish in order to rebalance this area of price so that we could be bullish again, but we had to be bearish to rebalance so that we could be bullish again. Okay, I hope I explained that in a simple way that you can understand. So this right here is your fair value gap, right? Obviously, okay? That's this, okay? So let's say there was 3 candles that made up this line, right? And we had our gap. So we start heading down, right? Our manipulation leg, the leg that's in the opposite direction that we want to favor, because let's say I want to target this high, okay? So now when I'm going up, let's say that there's a gap along our manipulation leg, right? This one. So price comes down, we start heading up. Once we cross through here and we cross through that gap, right? So we went down right here, right? We went down into the gap. Okay, so we went into the gap, and I'm going to erase this so it's not in the way and not confusing. Okay. So when we came back down into our gap, right, we respected it, right? So, boom. We came back into the gap, and we respected the bullish gap, Hence why there's a green check mark, right? We just respected the gap. Sorry if I'm over explaining this, but I really just want to make you guys understand, right? So this gap was created on the bullish leg up. Okay, we came into it and we didn't trade below it. We just stayed within it and we had a nice reaction out of it. So we respected it, okay? Now I'm going to use red to show the manipulation leg, right? So this is our manipulation leg. Okay, this is the leg that is in the opposite direction that we want price to go in. Okay? So, with that in mind, we probably will make another gap along this leg, or if we don't take a trade, a little bit more advanced. But let's just say in this case, we had our bullish gap. We came back into it, right? We start reacting out of it. And this is our inverse, right? The gap that gets pushed through. Remember how I said that if we respect the gap like so, right? That's just a fair value gap. But let's say there's a gap higher here and we just blow through it, okay? We inversed it, okay? If I'm looking to be bullish and aim for prices higher, I'd like to see us push through this gap and inverse it. So I won't get into that too crazy. I feel like I've already gone off too deep, but that's what an inverse is and how you could use it. Okay, and we went over this and we went over those. So I'm going to move on to the other things that we were talking about. And I think that might be it. Is that it? Yeah, okay. So that was the video for today. I hope I explained things to you guys in a way that is unique, hopefully a little bit different from the mainstream videos that are coming out on YouTube. I know you guys can watch a lot better edited videos and higher quality produced videos, but I feel like the way I'm explaining it is that of a literal normal human being, and hopefully it resonates with you guys. So if it did, give me a like, give me a subscribe, maybe leave some comments. I don't know, do what you want. If how I explain things didn't make sense to you, then don't watch. It's fine. I'm only doing this for people that like the way I think. And yeah, thank you for watching.